Well, good evening, ladies and gentlemen, and welcome back to Foundations of Stocks and Options. I hope you've all had a fantastic weekend and a fantastic week. It's been a week since we saw you last. Keith says, is this class 5? It is, Keith. It is class number 5. And that means we're talking about trend following tonight. Of course, if you, for some reason, are a little bit out of sync, the reason that we're doing class number 5 tonight is because Tuesday I was traveling back from our board meetings over the weekend, and there was just the way that the meetings ended and the way class was, there was no way I could be back in time for it, and so I needed to punt. And so tonight, we're doing class number 5. We will do class number 6 on Tuesday, class number 7 on Thursday, just like we would normally go. And then the following Tuesday, which would normally be part of our week off, the following Tuesday, we'll go ahead and do class number 8. And so everything will just fall right in line, and then you'll just kind of have a week break, basically kind of like what we just had, and we'll pick it up the following Tuesday with level 2. And so just to give you an idea, that should all line out. Let me look at my calendar here while I'm talking to you. That should all line out that we will complete classes on November 11th, and we will start level 2 on November the 18th. So that's the way that whole cycle will flow. So we won't have a whole lot of hiccup there. And then just so you also know, we will also skip a week, or a class, I should say, on Thanksgiving, because the way the schedule fell this year, there's not enough time between Thanksgiving and Christmas to get a full cycle in. And so we're just going to have to straddle Thanksgiving. So we'll do the exact same pattern. We'll do class number 1, class number 2, 3. We will skip the Thursday, and then we'll do class 4 on the following Tuesday, December the 2nd. So it will all flow out. It will all make sense, and we'll all be happy. Anyway, it'll all flow great, and that's probably all I need to say about that. Let's see. Do I have any housekeeping issues I need to take care of? Any questions before we get going? If so, then type them in. If not, then let's get rolling here with tonight's class. Tonight's class, we're going to talk about moving averages, and we're going to get into the basic trend following system, and then we're going to talk about how moving averages connect with the line drawing that we've been learning up until now. A really fast spot check. For those of you who are new, I would love to get some feedback on how you're enjoying your classes. For those of you who are retake students and this is your first time to experience this version of the classes, I would really appreciate your feedback as well. I hope that what you've been experiencing, for those of you who are retakes, I hope you've been experiencing even more streamlined in terms of the education, straightforward, easy to understand, and I hope that it's helped you really, take your trading to another level. And so I'm very excited about that. Those of you who are new, some of you are new and you've not been to level 2 and 3 yet. Do I have anybody here who's brand new? And by brand new, I mean this is your first real Trade Smart experience. Do I have anybody here who's brand new and you've not been to levels 2 and 3 yet? If that's you, Anthony has mentioned that. Anthony and a few of the rest of you here, I think I've got a good 35 or 40 of you in here. You're probably going to want to start thinking about, hey, do I want to continue after level 1? Is level 2 and 3 where I want to go? And you're going to find that level 2 and 3 are really the other half of the whole system. Level 1 is fantastic. Level 2 and 3 just takes it to a different level. And so you're going to really appreciate when you get there, all right? By the way, any of you who are new, if you've not built your relationship with Michael Longenecker, our student success coach, this would be a great time to start talking to him about some of your ongoing training that you'd be interested in doing. This is just a great time in the process because he can kind of pick up with where you are, give you some coaching guidance about where you need to go and any kind of dark corners you've got there, all right? All right, let's pick it up here. Let's keep going here. I'm going to do a quick review here. I like to do this every once in a while. Quick review. I shared with you in a previous class, I believe it was class number 1, that if you're going to be a successful trader, there's really 3 things you got to have. You got to have a winning psychology, you got to have a winning analysis, and you got to have a great winning strategy. We've been working through these things together, the winning psychology, the analysis, and the strategy. I spent most of our time talking about the analysis, but if you remember class number 1, we talked about the psychology just a little bit. We talked about it in terms of discovering your why. What is your driving force behind your success? And I associate it with a phrase that I call your created purpose. It's really the reason that you feel like you're here driving to get to financial freedom and financial success. If all you're focused on is the fact that you want money, well, you're probably never going to get there. It's going to become that elusive carrot. But if you've got a real reason to go after the money, then you get really clear on that purpose. Then you discover that the money is just a tool. It's something that facilitates where we're trying to go. And when you've got a clear purpose, those obstacles that kind of get in the middle of the way, they're not really that big of a deal after a while once you have a clear purpose. Usually if you find yourself, kind of setting goals and you're not quite getting there, usually it's because you haven't really uncovered your purpose to the point that it's emotional and you've really owned it to that point. Once you get there, these obstacles that seem like they're keeping you beat down, well, they're easy to push out of the way. And so that's kind of the psychology. It's part of the psychology. It's a very small component of it. In terms of the analysis, we've learned a general understanding of my analysis process. We've learned about support and resistance. We did this in class 2 and 3 and some in class 4. Learned about support and resistance. We've learned how support and resistance are the framework for your stock. We've learned about pivot points and price targets. And we've learned that all of these things we've talked about, support and resistance, framework, pivot points, etc., all help us establish our bullish or our bearish trades. And that's specifically the direction. Are we bullish or are we bearish? How many of you feel like after the first 4 classes, you've got a better understanding of building a framework around your trades that maybe you used to think were a little bit, I don't want to say scrambled, but maybe random. You didn't necessarily know which way the stock was going. And once you start drawing those lines in there, once you start getting that structure, it becomes very clear. And then once you start having those boundaries, you have a good idea. Hey, this is support. This is where the stock should be turning. This is resistance. This is where the stock should be turning. Once you start to see it, you wonder how you ever traded without it. But until you can see it, until it's made clear to you, it's just elusive. And so hopefully we've made that clear to you. Then we've talked about the winning strategy. I've taught you 2 strategies in their most basic form: buying stock long and selling stock short. When you buy stock long, you're bullish. When you sell stock short, you're bearish. And so we're starting to lay the beginning pieces. I don't want any of you to feel like right now you should be experts. You should not be. You're 4 classes into a program that ultimately is 24 classes. And so, to think that after 4 classes you're an expert, that's just not being realistic. Let's call the truth, and the truth is we're tiptoeing in. But what you do have after the first 4 classes is you've got a general idea of some of our psychology, you've got a general idea of how we start to do analysis, and you've got a general idea of how we start to pull together strategy. Now what we're going to do, you're going to start to see a shift. Starting with tonight's class, we're going to start to get into some more detail. Up until now, I've kind of been a little bit more broad market. I've been laying some key rocks or some key foundational points. What we're going to start doing tonight is start moving into the idea of trading systems. Now, up until now, in terms of picking a direction, all you've really seen is support and resistance. We've learned that when a stock's selling off to support, it tends to, when we find that support level, we start to find the buying behavior, and the buying behavior tends to send the price of the stock higher. And when we run up into resistance, the selling behavior starts to show up. Take a look over here at the Dow. About the last time we met, I don't have the exact day on here because it doesn't say which day, but we can estimate it was somewhere back here. We were running into some initial support levels, and if I recall in our last class on the Dow Jones, we talked about these long lower candlestick shadows, and I said that this is buying pressure, and we recognized that buying pressure was happening at a known support level. How do we know it's a known support level? Well, we got a line there. Why is the line there? Because if we come to the left, you see that was some additional support levels historically over there on the left side. That's exactly where the buying pressure came in. Now, we rallied quickly through all of these other support and resistance levels, and now, as of today, we've rallied back up to a resistance level. We are at a perfect location right now where we are in the Dow Jones today after a 221-point rally. We're in the perfect location for the stock, or in this case, the index, the overall market, to reverse and go the other direction. Or we are in the perfect location for the index to continue higher. Now, I know that sounds random. You're like, well, of course, it's either going up or down. However, notice I didn't come over here to 1700 and say, oh, this is the perfect location. I waited until we're up here to resistance. When the stock comes into resistance or it falls into support, it's like it comes into the zone. And once it gets into that zone, now you know we're either going up or we're going down, or maybe we'll get stuck sideways for a little bit. But this is our pivot area. And so about the time we had our last class, again, I forget exactly which day it was, but around the last class, we were at a pivot area that we would call a support. Now we are at a pivot area that we would call a resistance. And now what we need to watch for moving forward tomorrow and then into next week is, do we start to see some selling pressure? Or does the buying pressure continue, and can we continue higher? Now, the next tool I want to teach you, this general idea of framework is really, really powerful. And if you just have seen what I've shown you here, if you've seen what I've taught you up until now, then you're starting to see that support and resistance gives you boundaries in your stock. But what support and resistance does not do is it doesn't specifically tell you when to get into a trade. It doesn't specifically tell you where to set your stops. It gets you some ideas, but it's not a trade following system. It's just kind of some boundaries. Does that make sense? And so as you think about support and resistance, you need to realize that support and resistance is a framework. What we've got to do now is we've got to start turning that into a trading system. And the trading system that we're going to start learning tonight is a trend following system. When you're buying stock and when you're selling stock short, trend following is really the only way you can make money. You're not going to make money if you buy a stock and the stock goes nowhere. You're only going to make money if you buy a stock and the stock goes up, or you'll make money if you sell a stock short and the stock goes down. And that's the only way you're going to make money. And so what we need to do is we need to identify where these trends are beginning and how do we follow the basic trend following system. That's what we're going to be getting into tonight as we start talking about moving averages. Let me address a question. Robert said, is there a class 5 notebook revised available? Yes, Robert. It was emailed to you this afternoon. I deleted it from my account, or else I would tell you what time it went out, but maybe some of your other fellow students can tell you a timestamp. It is definitely was sent out, and it should be in your email box. Maybe if you're on Gmail, sometimes Gmail likes to put everybody in the promotions folder, so you might check that folder, Robert. But it definitely went out. Bob says he's not getting those notebooks. Okay, well, you should be getting them. Check your junk folders. And what I'm going to do is I'm going to check with Sean and see if he's getting them up to the website as fast as he's getting them emailed out as well, because there's no reason that they shouldn't be up there as well. Anthony is saying that the email went out about 12:30 Pacific time, so about 2:30 Central, 3:30 Eastern time. So it should have been in your email box maybe around 6 hours ago or so. All right, let's continue here. Where was I at? What about moving averages? All right, what are moving averages? Moving averages are an average of the closing price of the stock over a specific number of days. By the way, what I'm teaching you with averages, it works with futures, works with Forex, works great with foreign currency, works with any market. So I'm teaching it related to stock, but it will work with all the markets. So the moving average is simply an average of the closing price over a specified number of days. And whenever we talk about an average, realize that an average is literally what the word means. You take a whole bunch of prices, you add it up, and you divide it, and that gives you the average price. Well, the reason it's a moving average is because the average is changing every day. Every day we get a new closing price, and that closing price gets factored in, and the average now adjusts. And so what we've got is we end up with a line that is moving along with the stock, and it's showing us the average price of that stock over whatever given period of time that is. Now, you say, well, why would we want to see the average price of a stock? Here's why. Because when we see the average price of a stock, it starts to smooth out the trend. Take a look at this picture over here on the right side. Notice that the stock is running up and it's coming down, and it's up and it's down, it's up and it's down. But you see this moving average? Look how nice and smooth it is. It's just coming right along, and it's just averaging out the price of the stock in a nice smooth trend. Well, that's really nice, because what the moving average will do is it will help us kind of cut out the quote-unquote noise. When you've got a stock going up and down, and kind of an irrational, erratic price behavior, you need to smooth it out so you don't necessarily get caught up in the irrational whims of the movement. That's what the moving average will help you do. So with that in mind and understanding that, let's talk about how that smoothing happens and why it's beneficial for us here. Because it's smoothing the price, it becomes very beneficial for seeing how the trend is shaping up overall. But what you need to understand about that average is it's not going to be beneficial in a sideways moving market. It's beneficial in a trend, but not in a sideways market. Let me show you what I'm talking about. Take a look at this next picture. Notice this price action on Apple, and this was a while ago because this was when Apple was up at $600 a share. But notice what happens in here. You got some price actions moving up and down. And if you're not careful, some of these little black candles were maybe $8 or $10 down. This current day that you see here was a $25 candle down. And you say, well, my goodness, $25 down, this trend is done. Well, is it? Because you notice what's happening with this average. The average is just nice and smooth, moving along here, showing that the trend is continuing in a bullish manner. So what we're seeing with the average is the average takes that erratic behavior and it smooths it out. And now we can see a nice smooth trend. That's the benefit of the moving average. Now let's compare that trend to the moving average in a sideways market. In a sideways market, the erratic movement doesn't help, and because there's no trend, the moving average ends up going sideways. You see how the stock price action in this particular picture is moving constantly above and below the average here? You see how that's happening? And so then you got these green and orange and red lines, and they're going through the stock. And yeah, it shows you the average price, but it doesn't help you at all. It's not smoothing anything out. In fact, it looks even more chaotic. All right, so in a trend, the moving average is exceptionally beneficial because it helps smooth the trend. In a sideways move, the moving average is really not going to do you any good at all. All right, now with that understanding, let's talk about how we're going to use the averages and the various types that we'll be working with. There are two types of averages. We've got the simple moving average and we've got an exponential moving average. Both of them have a purpose. Both of them have a place. I'm not going to sit here and try to convince you that one of these is better than the other. All right, they're both just what they are. They're just moving averages. So here's how they work. There's two types of averages. We've got simple and we've got exponential. A simple moving average is a simple calculation of the closing price over a specific time period. That's all it is. So think about it. There are 4 price points on a chart. Would somebody please tell me, what are the 4 price points on a chart? On any given day, there's 4 key price points. Somebody help me out here just in case I forgot. What are they? You're absolutely correct, William. William said the open, the high, the low, and the close. You're totally correct, William. So what the simple moving average is going to do is it's going to take that 4th price point, the closing price, and it's going to average that price point. So let's assume for a minute that we've got a stock that on day 1 closes at $10, on day 2 it closes at $11, on day 3 maybe it closes at $12, and on day 4 closes back at $11, and then finally at maybe $10 a share. Well, how would we figure the average of this? Well, you're simply going to add these all up. So 10 plus 11 plus 12 plus 11 plus 10, unless my brain has stopped working correctly, that should be 54. Okay? Did I get that right? Now, how do we get the average of these prices? Well, the way we're going to well, first of all, let's draw a little chart here. Let's say that we've got 10, 11, 12, $13, $14. Okay, so on day 1, we close at 10. Day 2, we're at 11. Day 3, we're 12, 11, and 10. Okay, now we're going to draw our line chart. There's your line chart, your basic line chart. Okay, now how do we average that? Well, we're going to add these 5 price points up, and I'll change colors so we can see this. And if you take 54 and you divide it by 5, what do we get? We should get about 10.8. Okay, so on the 5th day, we can average the last 5 days, and we can plot this and say the average price is the blue line, and it was 10.8. Okay, that's a little bit less than 11, 10.8. Well, the next day, the stock closes back at $11. Okay, so how do we average that? Well, we'll take the 10 off. We'll add all 5 of these up. That should give us 55. If we divide, let's plot our chart at 11 for the next day. Boom, there it is. Okay, if we divide 55 by 5, that should give us 11. And so for the next day, we'll plot the blue point here. This will be the moving average. So now over the last 5 days, the average price has been 11. And you get the idea. If we took this another step further, we would just say the next day, maybe the stock closes at 12. So the last 5 days, we get rid of 1. Last 5 days added up to 56. 56, we'll plot 12 up here. Stock is moving higher. 56 divided by 5 is, well, my brain doesn't work that fast, so let me punch it into my calculator here. 11.2. So that's our average price, just a little bit above 11. You see what's happening? The moving average is coming behind the price action of the stock. Now, this is always the way it's going to look. The moving average will always trail behind the price action of the stock, and all it's doing is averaging the last several days of what that price action was. In this case, it's a 5-period moving average. Does that make sense? Now, we can take this and we can plot it on any time frame. Technically, we could use a simple moving average for a 5-minute chart. We could use it for a 10-minute chart. We could use it for a 10-day chart. I usually, personally, this is the Jeremy specificity, I typically use a moving average for the long-term trends. This is when I will use them. It is not a hard and fast rule. You do not only have to use them for the long-term trends, but I typically do that. So here's my question for you. Ralph, how long do you think a long-term trend would be? If I were to just throw out to you randomly, long-term trend, how long would you guys associate that to be? What would be a long time to you? Any ideas? 6 months, says Robert. Okay, that's a pretty good trend. A year, 1 to 2 years, says Bob. Leon suggests 5 to 10 months, a year or more. So all of you are kind of coming into about the 5 to 12 month range so far. Anybody got a different idea of what a long time is? Nobody's got a different idea? I'm surprised. I always have a few of you that have a different idea. Some of you might come out and say, well, I think a long time's 5 years. Someone might come along and say, I think a long time is a week. And what I can tell you is none of these answers are right or wrong. They just are. What it tells me is it's an insight into your personal trading personality. For example, if Lorenzo tells me that a long time is a week, and John tells me that a long time is 10 years, I will tell you that Lorenzo is more likely to be a day trader if he thinks a long time is a week. And John is more likely to be a very long-term trend trader if he thinks 10 years is a long time. Lorenzo and John, how close am I? For those of you who think that 1 year is a long time, you're kind of more of an intermediate trend trader. Those of you who think that 6 months is a long time, you're going to be kind of more of an intermediate trend trader. How close am I? I know I'm pretty close because I have done this for quite a while, right? I'm not sure what you wrote in there, Lorenzo. I think he says he wishes to be a day trader, but he's not currently. I think that's what he meant to say there. Anyway, so yeah, here's my point. The time frame is very relative, and there's not a right or wrong answer. So let me give you my perspective on how I use these averages, then you can adapt it to your own personality here. For me, I'm going to use, for a long time, a setting of 100 period and 200. Now, what does that mean? On a daily chart, the 100 period is going to be approximately 5 months. Approximately 5 months. It's about 20 weeks of trading time. And so I'm going to use the 100 period and the 200 period, which is going to be about 10 months, all right? Now, the reason I say about is because it's, officially it's 200 trading days or 100 trading days, and you're going to have some holidays in there. And so, it may not be exactly to the T, but it'll be pretty close to about 5 months and 10 months. And I'm going to use these two trend lines together, these two moving averages together. Now, one of the reasons I use these settings specifically on a daily chart is if you listen to the news, you will notice that the 200 period and the 100 period are moving averages that big institutions will often look at. And so it's valuable to understand what they're looking at. And they are looking at the simple moving average. And it's very valuable because if, for example, a couple weeks ago, when the markets were selling off so rapidly, there was a lot of talk about, are we going to drop below the 200 period moving average? Well, if we start dropping below the 200 period moving average, for a lot of institutions, it doesn't matter what the logic is. If you drop below 200 period moving average, they just start selling. Lorenzo, do you think that's pretty valuable to understand where institutions might start selling? If you've got a tool that institutions look at, and maybe they're even more fundamental traders, but they happen to look at this one technical tool, and you know that if they start dropping below that price point, this is a really valuable place to know they're going to start selling? Yeah, because if you start dropping below that 200 period average, and you know all these institutions are going to start selling, well, Edmund, what would you like to do? Well, you'd probably like to be shorting about then, wouldn't you? Yeah, you want to be shorting. They're going to be selling to close their positions. You're going to come in, you're going to start shorting it, and a bunch of other people are, and that's actually going to become a bit of a self-fulfilling prophecy. In other words, whenever the stock starts to drop below 100 and a 200 period simple moving average, you're going to see a lot of selling pressure, even if it's irrational, because people are looking at the same thing. And so if I can give you a little tip and say, hey, this is what the institutions are looking at, you probably are going to want to look at that same thing as well, just to keep it in the forefront of your mind. Now, let's learn about the exponential moving average. The exponential moving average is very similar to the simple, but the difference is that the calculation is going to be a little bit more complicated. And the only way I really know how to describe it is to say it this way. It's a complicated calculation of the closing price over a specific time period, and here's what's complicated. It has a heavier weighting on the more recent trading days. So just think about it this way. If you've got several trading days out there, let's say you've got 10, 11, 12, 11, 10, which one of these is going to be the most important? Well, the day that just happened, the exponential moving average is going to weigh that a little bit heavier than the 10 closing price that happened a week ago. That's what an exponential moving average is. Now, I can give you the formula. It doesn't do you any good, but I'll give you the formula just for those of you who really want to see it. Here's what the exponential moving average formula is. All right, you can read it right here. Now, here's the problem. This is not going to do you one lick of good unless you just like to look at formulas. And if you like to look at formulas, well, there it is. I think it's in your notebook, and you can twiddle your thumbs around it and look at it. The truth is the computer does all the work for you, so who really cares what the formula is? What I care about is the fact that you know what an exponential moving average does. So, Robert, do you know what an exponential moving average does? Well, yeah, it's a moving average that has a heavier weighting on the more recent days. Let me give you a picture. Before I do that, let me ask you a question real fast, Robert. Which one do you think is going to react faster? The exponential moving average or the simple? Obviously, the exponential moving average is going to work faster. Take a look at this. I've put two moving averages on this chart. The blue one on top is the simple, and you can see that it reacts a little bit slower than the exponential, which is on bottom. They're very, very close. They're not radically different in the way that they react to the price action of the stock, but In a downtrend, the exponential is going to be a little bit closer to the price action. And whenever it starts to cross back over here in the kind of the more sideways move, you're going to notice that it also is reacting quicker. And so you see just a few subtles here. They're both 20 period. In the case of this picture, both of these are 20 period moving averages. The dark blue is the simple, and the kind of turquoise is the exponential. And you can know that on my charts. You can look up here and see it says moving average, and then the turquoise is moving average X, which stands for exponential. And so that's what an exponential moving average is as it compares to a simple moving average. Now, why would we want to use that? Well, technically speaking, we can use an exponential on any time frame, just like we can with a simple moving average. But for me, I typically use the exponential on a shorter time frame. I do this because it's not as valuable over the long term, and on the short term time frames, it gives me a little bit better signals. That's why I like to use the exponential. Now, you get 10 technical traders in a room, and you'll probably get 10 opinions on whether you should use exponential or simple. I don't know that there's a black and white rule about this, one that we have to follow. But for me, I typically use the exponential, and that's the one that I've set up for you in your templates, all right? So the exponential I typically use for shorter term. Now, with that in mind, Leon, tell me, what do you think a short term would be? If I say that I'm going to use this tool for short-term trades, how long would a short term be? Well, if a long time I said was a 100 and a 200 period, recognizing, approximately 5 months and 10 months of trading data on a daily chart, what would a short time be? We know it's going to be less than 100. I'm going to propose to you, well, I'll read some of your answers. Robert Sistanich, did I say your last name right? Sistanich, maybe? Says 1 minute. That's a short time to Robert. All right. Lorenzo says 1 day. 2 to 6 weeks, says Bob. John says 10, 20, and 50. He read my notes. Leon says, I'm ready. I'm reading the study guide. Yeah, you're reading. All right. You got the study guide in front of you. It doesn't help. So here's the settings that I use. I use a 10, a 20, and a 50. The 10 period is approximately 2 weeks. It's 10 trading sessions on a daily chart. That means it's going to be 2 sets of 5 days. So it's about 2 weeks, depending on holidays and whatnot. But just basically, it's the last 2 weeks of trading. A 20 period is basically the last 4 weeks, or the last month of trading. And then a 50 period is going to be 10 weeks. I use all three of these moving averages together. So those are my settings. Now, someone may come back and say, well, what do you think about using a 14, a 28, and something else with it? Well, you're welcome to use those numbers. A lot of people try to apply Fibonacci ratios to your moving averages, and I'm okay with that. The 14 period that became popular because of the lunar cycles, the 14 and the 28. You can look at the 5, the 13 period. You get into the Fibonacci cycles. Those are all Fibonacci numbers I just said there, 5, 8, 13, etc. Some people like to use those. What you're going to find is if you get them at approximately this spacing, where your fastest one's about 2 weeks of trading time, the difference in 8 and 10, not that big of a difference. The difference in 20 and 28 is a little bit different, but if you space it out kind of 14 and 28, 10 and 20, you're going to get about the same readings that you need. So I don't think that there's the perfect setting. Again, I use the 10, 20, and 50. They work very well for me. It's not always black and white, but these are going to work well for most of your trading situations. And I would not spend a whole lot of time second guessing these settings. If you want to second guess settings, there's some other stuff that you can second guess your settings on. All right. So 10, 20, and 50. This is what I typically use together. Now let's talk about the benefits. Now that you kind of have a basic understanding of averages, there's 3 tools or 3 ways, 3 techniques, whatever you want to call it, that I use the moving averages for. And if you've never seen these before, this will change the way you trade. It truly will. They're very simple. That's the truth about this tool. It's extremely simple. So simple that, frankly, most people forget about it. But if you'll pay attention to this, it will hook you up for success. And here's how it works. The first one is choosing your trend direction. Great tool for helping you figure out your trend direction. It's very common too, by the way. The second way I use it is as an entry trigger, which is a little less common. And then finally, the third way is relatively uncommon, and that's kind of my secret weapon in terms of trend identification. So I'm going to teach all three of these to you right now, if that's okay with you, of course. But, maybe I need to ask you if I can have permission to teach all these to you. You okay with that, Kenneth? So the first one, the trend direction. Again, this is the one that almost everybody knows how to use if you know moving averages. And the idea is simply bullish versus bearish. And here's how it works. The average, the moving average, serves as a midway point. Remember what I said about the institutions and the 200 period moving average? I said if the stock drops below it, the institutions start selling? Yeah. Well, here's why. Because the institutions, they're not stupid. They know that the moving average is a very simple system that indicates if you're above the average, you're in an uptrend, and if you're below the average, you're in a downtrend. They know that. You should too. Above the average, you're in an uptrend. Below the average, you're in a downtrend. Now, what happens if the stock and the average are kind of going through the same territory? Well, you've got a sideways moving trade, and that's what you're going to want to avoid. If you're in a sideways moving market, the moving average system is not going to work well, and you're not going to make a lot of money. You're just going to get a lot of headaches and use a lot of Excedrin. So you want to try to avoid sideways markets when you're trading a trend, obviously. Otherwise, this becomes a very, very simple and basic tool. Take a look over here at this picture. Notice what happened with Caterpillar on this picture here. We are above all three of my moving averages. I've got my 10, my 20, and my 50 on the screen. And notice that we're above all three of them, and we're in an uptrend. We kind of started to move sideways here. We're back into the uptrend. And as long as we're above the averages, we're in an uptrend. Now, notice how these three averages are working together. The 50 period is very much the intermediate trend. Very much the intermediate trend. An intermediate trend, for those of you who are not familiar with this terminology, an intermediate trend is typically going to be about 6 to 9 months. Sometimes it'll only be about 3 or 4 months, but normally it'll be a pretty good sized trend. The intermediate trend. And this is a very profitable level of the trade to trade on. And if you look at the 50 period, you're going to notice, okay, so we move above the 50 period right here, beginning of September, and we stay above the 50 period really all the way up until the trade has increased from $65, maybe $70 a share, up to well over $100 a share. We had a couple times where we traded back to the 50 period, but as soon as we hit the 50 period, we bounced and we continued higher. This is what institutions are looking at. You'll also hear the institutional players talk about the 50 period. All three of those, the 50, 100, and 200, are levels that institutions tend to look at. And if you're a longer-term trader, this is going to be a level of the moving average that will be very beneficial for you. Now, look at the more short-term trend. And look at this 10 period, this the kind of the turquoise aqua colored one in here. And notice what happens. We break above the 10 period, and as long as you're above the 10 period, you're in a bullish trade. We start to drop below it, and then finally we break back out. And the trade did continue, but notice what happened here. For chunks at a time, a week or two at a time, we're just going sideways, and those become very frustrating. So you typically, as you start to drop below the 10 period, if you're trading the very minor level trend, which is the more short-term trend, you're going to want to avoid those trades. So if you're an option trader, the 10 period becomes a very valuable moving average to look at because it's very short-term in its nature. Makes sense? So all of these are valuable. All of them are going to give you a little bit different perspective. I'm just kind of explaining to you why some of these are looking like the stock is above it versus some of them where it looks like the stock has moved below it, but the trade was still good. Let's look over here at the first solar trade. This was a bearish version, a bearish picture, I should say. And again, look at that 50 period, that long-term kind of intermediate term trend. This trend lasted a long time, and notice what happened. We stayed below the 50-period moving average. We poked our head up for just about a week, and then we were right back below it. The bearish trend continued. We poked our head up. The bearish trend continued. And in this case, over the course of several months, about 12 months here, from the time that the stock dropped below it, we dropped below it back here, but then we got the trade going here in April 2011. At that time, the stock was about 150 a share. And by the time this chart is done, we're down here to less than $20 a share. And by the way, that was First Solar in the middle of a bull market. So this was very much counter trend to the overall market. How many of you think that's simple enough you could do that? Even those of you who've never traded before. This is kind of like a red light, green light. If I'm above the moving average, I'm bullish. If I'm below the moving average, I'm bearish. Sean Tate, are you here tonight? I don't know if Sean's here. Let me look in the list here, see if his name. Here's name's here. He never writes in. I think he's on an iPad or something. But Sean, if you're listening to me, you were asking me at lunch a couple weeks ago the best way to know when to get in and out of a trade. I tell you what, this is my dummy-proof method for trading. If you have no other tools available to you, if you can't figure out how to draw support and resistance, if you can't figure out anything else, figure this one out. This is dummy proof. This is what I would hook my mom up with. I would say, Mom, when I'm below the average, short the trade. If I'm above the average, buy long, and don't ask any questions. Just do that right there. Now, is it perfect? It's not perfect, but it is one of the best jump starts you can get, and this moving average trend following system will keep you in the right trade usually longer than any of the commentators or anything you watch on television or anything else. So this is a very, very good trend following system. And I'm going to put together a better system later tonight, but I'm just kind of getting you prepared at the simplicity of this idea. Above the average, we're bullish. Below the averages, we're bearish. Now let's look at a situation where the stock is moving through the average, or better said, the average is moving through the stock. The point is that the stock is moving sideways. And so look at this Rambus trade here, and notice how the stock is it's really erratic, up and down, up and down, up and down. Now the price was not moving very far either. If you look at this from its extremes, we're only down here about $17.50. Up here at the high levels, about $22. So we've only got about $3 or $4 here. You kind of have some channeling action. You should all kind of identify that, oh, there was a little bit of an upward channel there, but it was ugly. It was a little sloppy. The only way you could have traded this would be to trade it like a channel, but notice what's happening with that average. The average is right in the middle, and this is where it's going to drive you crazy. If you get into a trade like this where the stock's moving sideways, you'll have a situation where you think, I'm going to buy it, and then before you know it, oh, shoot, I got to sell it. And then you're down here and you're like, yeah, I'm shorting it down here and up. Now I got to cover, I got to buy. And you're just back and forth and back and forth. And this situation, sometimes it'll make you money, but usually you're going to break even or lose a little bit of money if the stock is going sideways and you're trading a moving average system. So I want to give you a big fair warning here. The moving average system in a trend is phenomenal. It's your best friend. In a sideways move, it'll nickel and dime you to death, and you're not going to be very happy chasing those trades. So I'm just giving you a warning here, and I'm going to give you some tools on how you can avoid that as we move through tonight. So when do we use the basic system here? Well, here's how we're going to do it. For your short-term trades, we're going to use your short-term averages. In other words, if we're looking at a trade that's anywhere from 2 weeks up to a couple of months, you're going to use your 10, your 20, and your 50 period. If you're looking at a longer term trade, you're going to want to look at those longer term moving averages, the 100 and the 200. Okay, so I forget now who it was. Maybe it was John said that he felt like 10 years was a long time. Well, John's probably a longer term trader. And so, John, if you're a longer-term trader, you're wanting to get into trades and maybe hold them for a year or two, you're probably going to want to be looking at the 100 and the 200 period, and you should look at the simple moving average. If you're more of a swing trader, you like to get into a trade, be into it for a few days, maybe up to a few weeks, which, by the way, is my style of trading. If that's you, you're probably going to want to use the 10, the 20, and the 50. Now, if you are a short-term trader, I want to advise you that you still need to be aware of the 100 and 200. You won't trade off of them, but you do need to be aware of where they are because, again, it will give you some insight into institutional money at various times. Now, what if you're a day trader? If you're a day trader, I would tell you use the short-term settings, 10, 20, and 50 on any time frame. If you're a day trader, 10, 20, and 50 on any time frame, and they will set you up for relatively high-level success. Okay? Any questions about that component of moving averages? If not, I'm going to move on to the second way that I use the averages, but if you've got a question, I'll be happy to entertain it. This would be a decent time to ask it. I'm going to drink some water before I get to my second point and give you a second to write a question in. Okay, Steven asked a question. He says, will this work for any stock? Yes. You do not have to pick. Let's just... Now, I'll do more live analysis later tonight, but yes, it will work for any stock. And, I'm not one of these that believes that you need to go scanning for stocks and just finding that big special trade. The truth is that most stocks are constantly moving between an uptrend, a sideways move, and a downtrend, and back around. They're always going through these cycles. So if you can just identify any stock when it's in that cycle, you can use the moving averages to work through it. Yeah, absolutely. Okay. Daniel says, for day trading, you use 10, 20, and 50 for like a 5-minute chart. Yeah, Daniel, you can use it for a 5-minute chart in a day trading scenario. Absolutely. Wayne, I'll talk about that in a minute, buddy. Let me answer that question in about 6 or 7 slides. Okay, I'll get to that. Gary wants to know, do the moving averages hold for resistance more than horizontal lines? We'll talk about that in a few minutes too, Gary. The answer is no, but we'll talk about that later as I get to that part. All right, I don't think I have any questions about basic trend direction, so let's move to the second type of situation that I use the moving averages for. And this is what we call an entry trigger. The second way I use moving averages is as an entry trigger. Number 1, for trend direction. Number 2, as an entry trigger. This is also known as a moving average cross. And what you get when you have a moving average cross is a buy or a sell signal. That's all it is. It's just simply saying buy now or sell now. Now, in order to get the moving average cross, you've got to have at least 2 averages. That's why I always have at least 2 averages on my chart. You don't ever want to have just one. If you just have one moving average, you're missing most of the signals that you can get. You want to have at least 2. Well, I don't want to say you're missing most of the signals, but you're missing a lot of signals. You want to have at least 2. I usually use the 3, the 10, 20, and the 50, and I use those 3 together. When you have a moving average cross, this is a strong signal of a new trend most of the time. There are some exceptions, but most of the time, the moving average cross is a signal of a new trend. So let's understand it a little bit better and how it works. Here's how it works. When the faster line crosses the slower line, right there. When the faster line crosses the slower line, it indicates a change in direction. It's that simple. When the faster line crosses the slower line, it indicates a change in direction. If you have a cross up, it's a bullish change in direction. If you have a cross down, like you see in my image over here, it is a bearish change in direction. Now, someone's naturally going to ask, which line's the fastest line? So I'll tell you, the fastest line is the smallest number. So if you're looking at a 10, a 20, and a 50 period moving average, then the 10 period is going to be the fastest line. If you're looking at a 100 and a 200 period moving average, the 100 is going to be the faster line. It's whichever one has the lower number, all the way down to, if you had a 1 period moving average, you'd have a a line chart for the day. So that one wouldn't be practical, but that would just basically be day to day. And so the smaller the number, the faster that moving average is going to be moving. Now, someone else might ask, well, what happens when the slow line crosses the fast line? Daniel, tell me, what do you think is going to happen when the slow line crosses the fast line? Any idea? It can't happen. It cannot happen. Don't fall into the trap of asking that question. It's a logical question because, you're sitting here thinking, oh, this is complicated. I'm learning something new. Fast line crosses. It's a change in direction. What about the slow lines move? Well, it can't move. It's too slow. That's why we call it the slow line. It's the slow kid in the class. The slow line can't cross the fast line. Only the fast line can cross the slow line. And so just remember that the fast line is always moving faster. It will always be the one that crosses, okay? So now, in case you were wondering that little question, you've got it answered. Now, which averages do we use? I use all of them. For my short-term trends, I use the 10, the 20, and the 50. And for my longer-term trends, again, I use the 100 and the 200. Let me show you some examples here. By the way, this is one of the greatest tools I'm going to give you. This is just an excellent, excellent tool that I'm giving you here tonight. Look over here at this Caterpillar trade, a couple years of Caterpillar trades actually. Where the black arrow is here, we can get into this trade as all three of those moving averages are crossing. That puts us in the trade about 105. You can stay in the trade until we cross back up, which gets us out of the trade about $85 a share, maybe $83 a share. Who would like to short at 105 and buy to cover at 83? All of you should want to short at 105 and cover at 83. That would be a great trade. Now, who would like to buy again when these averages are crossing back up around 85 and maybe sell it over here? Well, we didn't cross back down really. We never had a full cross. So you could stay in the trade or re-enter the trade here about 90. And then we finally crossed back down over here about 105. Who would like to make that $15 move? These are very, very basic trades right here. And they're profitable. The first one here, we short at 105. We cover about 83. Someone do the math for me on that. 105 minus 85 would be 20, so a couple more bucks. That'd be $22 there. This move here, if you got in an 85 up to about 105, would be 20. If you got in about 90 up to 105, that'd be about 15. So we'll call it a $15 trade that you had here. And now you can short again as we drop down below about 105, and you can short again around 105. And at the time of this chart, we're at the bottom down here back to 81. These are all profitable trades, and all we're doing is following the basic moving average cross system. Now, that's pretty powerful, isn't it? I think I know all of you can learn to do this system. Now, let me emphasize something. Out of all of the classes that we teach and out of all the students that we've taught, what I have been most surprised about are the number of students that ignore this lesson. And the reason I think that happens is because it's simple. People look at the moving average system and they say, wow, that's so simple. I understand that. And then we get into those advanced classes and we're learning about candlesticks and we're learning about advanced indicators, and they forget about the simplicity, this simple moving average system. I just wanted to say, put on the record, write it in your notes. If there's nothing else that you do, learn to trade a moving average system and you will be way down the road. This is a system that is profitable on its own. It's not the most profitable on its own. I'd rather see you add some additional tools, but in and of itself, it is a profitable trading system, and you should, for that reason, get very well acquainted with it. Let's look at a trade over here on IBM. Again, notice what happened. We got our moving average cross. There it is. And we never crossed back down. Even though one of them crossed, they didn't all three cross back down. Right here, had we gone bullish at about 130, you'd still be in the trade about $40 per share over here on the right side of the chart. This is a long-term trend. This is a big picture move here. And the whole time we're above the moving averages. And that moving average cross gave us a great indication that this trade was trading higher. Okay, now this is the basic moving average crossing system. Let's look at a bearish trade on a longer term picture. Look here. This is for the overall Dow Jones Industrial Average. Look at what happened back here in February 2008. Does anybody remember 2008? Anybody remember what happened to the market? This is when the market went from, at that time, at the highest high, we were around 14,000. And this moving average cross occurred when the market was down here in the 11 to 12,000 range. And, of course, by the end of 2008, the market was down here as a whole around 6,000. 50% sell-off. And not only was it a 50% sell-off, it was predicted by a basic 100 period crossing the 200 period simple moving average cross. People say we never saw it coming. I don't care if you see it coming or not. When your tools are telling you it's happening, you need to believe your tools. Notice what happened. We started dropping below the 200 period back here in August of 07. Then we dropped below it again in November of 07. We dropped below it again. 3 drops below the 200 period moving average. That should be a warning. And then what happened? We had the moving average cross. Everybody should have just been throwing their hands up, screaming, hey, this thing's going down. And, in fact, this thing was going down. Now, watch what happened after that. We start crossing above the 100 and the 200 period simple moving average. And by August of 09, we had a simple moving average cross of the 100 over the 200. And that was when the market was back here around 8,000. And today, the market's around 17,000. What if you did nothing but short index trades, maybe the diamonds, for the Dow Jones starting in January, February 2008, and covered them in 2009 when we bounced above the 100 period. And if we bought those diamonds again in August when we bounced above it and we had the moving average cross, and you held those till today, you would have made a 50% profit on the downside, and you would have more than doubled your money on the upside, just following the basic system. You guys can do that, can't you? Where do you think we are today? Let's come over here to the Dow Jones, and let's just look at this. We'll look at the long term. In fact, I'll get rid of all these lines. I got all the lines on there for reasons, but we'll get rid of all that. And let's just look at the big picture. Notice what happened last week. This is why it was a big deal. Or I say last week, it's a couple weeks ago. We dropped below that 200 period moving average. We don't do that very often. That's why this sell-off that happened just a couple weeks ago was such a big freaking deal. Because we started dropping below that. You remember what happened in 2007, don't you? We dropped below it. We came back above it. We dropped below it, came back above it. Look at how these lines are converging in upon themselves. This trend, maybe we're going to make newer higher highs. I don't know. Maybe we got a huge new bull market that's about to erupt, but we're running into resistance and we're bouncing back and forth above and below our 100 and our 200 period. These guys are moving sideways. This is not a strong signal currently on the Dow Jones. Now let's go back in time here. Since 2009, in August 2009, we crossed bullish. We had one bearish cross that lasted for about a month in 2010. We had one that lasted for a couple of months in 2011. And since that time, we have been in a consistent bullish trend. We've dropped below the 200 period just recently. That was a ferocious drop below it. We had not really done that outside of a day or so. We'd really not done that except for back in 2012. And then, of course, the big ones in 2011 and 2010. So anytime you see that picture where we've dropped below that 200 period, your little rabbit ears should be going up saying, hey, something big is happening here tonight. Does that make sense? How many of you guys can see that? That's a very clear, simple picture, isn't it? And it's easy to understand. Take a look over here at the shorter term averages. Now, the shorter term averages, you're going to see some more gyrations because we're constantly moving up and down. And what you see here, if you can see clear enough, I got it zoomed way out, but we actually had the buy signals. Oh, I'm not even far enough out. Let's come back here to 2009. We actually had buy signals on the short-term averages starting as early as April 2012. That's only 1 month after the bottom, this huge bottom, probably the best buying opportunity of your lifetime that happened back in March and April of 2009, and you're moving